Hello and welcome everyone to another episode of Almus Weekly Windup. This is your host Swaraj, and with me I have our market expert JK, and we will be running you through the week that has gone by. My first question is rather a long one, JK. We had a few data releases this week. The US non-farm payroll has increased by 4,31,000 last month. We are seeing unemployment rate in the US, which has fallen to 3.6%. Now, US is also seeing record inflation. And this week, one of the most common recession indicators, which is the US 10-year and the 2-year and the 10-year yield curves, has inverted. Now, given what is going on in the world, we are seeing supply side issues, a good robust demand, and there is also a war underway. Uh, what is your view on this possibility of recession? Do you think we might actually go into a recessionary scenario?
Hi, good to be back. Uh, Swaraj, as you said, the data on US employment was quite strong. In fact, the details were even stronger, where it showed that participation rate had increased. There was an upward revision to the previous month's number as well, and more importantly, just the previous day we had the PCE core inflation also that was published, and it once again showed that the inflation was still rising. And so there will be, in fact, more participants in the market expecting Fed to hike by 0.5% in the May meeting compared to what was expected earlier. So the resultant move after the job data, which was preceded by the inflation data, was quite significant. Expectations for a larger move by the Fed has increased, while analysts have grown somewhat sanguine about the growth moving forward. So when market is skeptical to buy a near-term bond but comfortable buying long end, it is telling us something. So the near term is driven by the inflation concerns, while the long term is driven by the expectations on growth. So as you said, the 2-year over 10-year was inverted by as much as 10 basis points at one point of time yesterday. And it has been studied that in the last 40 years, it has predicted 6 recessions. Okay. So it also, some observers say that it is significant only if it stays inverted for more than a week. So that is something that we'll wait and see whether it will happen. But things are not as straightforward as we think. Look at Japan. Japan has been doing yield curve control whenever their 10-year yield starts to move above 0.25% by buying unlimited amount of bonds. Now, what happens when they buy the bonds? They release a huge amount of yen into the system. And where does this yen go? Yen goes in search of yields in other countries. So US is one of the easiest and most sought after destinations. So the additional amount of yen that is printed by Bank of Japan goes into buying the bonds in US. Obviously, the investors buy the long-term bonds. Therefore, there is actually a yield curve control in the US because of the yield curve control operation done at Japan. So it is not just the expectation that the growth will be slowing down or there'll be a recession, but it is also a certain amount of demand in the long end, which is, simultaneous to the expectation of short-term rate increases that is contributing to this yield conversion. So it is some kind of nuancing of the whole thing that we are seeing. There is also another aspect to it. Till March, Fed's QE was in place. They were buying bonds till the end of March. Now, post-March, they are going to stop it. So, therefore, there was a demand for long-term bonds still from the Fed itself for, which was keeping the yields capped. Now, going forward, Fed is not going to print more money, but perhaps from May, they will reduce their amount of holding of the long-term securities as and when it matures in the form of quantitative tightening, which means that demand for the long-term bonds will also eventually come down. Then the yield curve, which is now inverted, might probably start shifting to the upside. So it is a complex situation. It's not as straightforward as calling it as a recession because it has inverted. But one logical explanation I can see is that if the inflation remains, not so much stretched beyond 2022 and it starts moderating, then at the same time Fed hikes rates towards 2%, etc. Economy might find it difficult to maintain the current momentum of growth. So that will actually mean that there will be a slowdown in the growth. So while it is not so straightforward, but still there will be some impact of higher rates, which some people interpret as a recession, but it's really something that we need to go forward and see what Bank of Japan does going forward, what Fed does, whether they really do the QT or not, and how much the inflation moderates going forward and the higher rates impact the growth. So it's something like very nuanced kind of a situation that we are seeing here.
Okay, so as far as my understanding goes, it is not the inversion is not a very straightforward indicator of a recession, right?
Yes.
It's like it's just one of the phenomena, and we are also seeing.
Just back on the Fed thing, there's one gauge which Fed watches, that is the spread between the 3-month T-bill and 18-month T-bill. So that is still not inverted, and that is quite on the positive side. So this is one of the gauges that Fed follows for signs of recession, and that is well in the positive territory. So you can so you have the arguments on both sides.
Yeah, correct.
Yeah.
But just one more question on this. So if there are signs of recessionary pressure, I'm guessing the Fed will not go with the aggressive rate hike stance it's currently taking, right?
Sorry, come again?
So if we were actually seeing some signs of demand slowing down, would the Fed actually go ahead with the rate hikes which it's planning?
I think for the moment they will focus on inflation gauge. If the inflation rate remains at these levels, they will simply go ahead with the rate hikes, even if they see some moderation in the demand. This is because in all the countries, politicians are extremely skeptical about high inflation, and the same case is with the US as well. So until the inflation starts to cool off, I think their actions will be, as per indications that is available now.
Right. Now, if I want to move on to the currency front, one of the major developments this week, we saw Russia announce that it would put the ruble on gold standard. So 1 gram of gold would be pegged to 5,000 rubles. At the same time, there's a demand by Russia for Western countries to pay for oil in rubles. What does moving back to the gold standard actually mean, JK? Because essentially, if we see now, oil payments to Russia will also be linked to gold indirectly. Am I correct in saying that?
So it's a very interesting and important development that's happening in the global monetary system. So Russia announced that it would buy gold from local banks at 5,000 rubles per gram between March 28th and June 30th. And this is below the current market value of $68. So this is actually achieving two objectives. One is, Russian central bank had announced earlier that it was halting official gold purchase from local banks due to surge in demand from regular consumers. But the resumption in buying will ensure that the supply and uninterrupted production of local gold will continue. So the purchase from Russia was something that was already in place. It had been halted for some time, and now it is resuming. Okay, so that's one aspect. The second is that Russia wants to increase the importance of ruble, backing it with gold. Although currently they are only purchasing, and they have not said that they will sell any amount of gold, or nor even they have announced a selling rate for gold. So suppose somebody wants to go and buy gold from the Russian central bank, that rate is not yet available. If that also actually becomes available, then you can probably say that there is a partial gold standard, at least in one part of the monetary system in Russia. So they also announced that they would receive payment for their exports either in ruble or gold or other hard national currencies, and thus it is actually seeking to reduce the importance of USD. So it should be noted that since 2005 alone, Russia has more than tripled its gold holdings. So they have fifth largest officially reported gold reserves after USA, Germany, Italy, and France. So their decision to back ruble by gold is well planned and will gain traction going forward. But to answer your basic question, no, we are not reverting to gold standard yet. But definitely we are starting the long process of diversifying the trade settlements and the reserve currencies, which would indirectly reduce the importance of dollar. Just that the US sanctions has hastened this process, and it can only gain more traction in the coming months or years.
Another question on that, we are seeing, essentially we are seeing a diversification of central banks' reserve currencies from, US dollar. Now Russia saying that it would basically not yet moving towards a partial gold standard, as you said. What cues what cues do you think the Indian central bank can take? Do you think we are also holding our reserves very concentrated in US dollars? Do you think it's a sign that India should also diversify its reserves?
See, I would say that even any central bank, including Indian central bank, will have its risk mitigation process. And already we have seen a huge move lower in the bonds of the US government. And I'm sure many central banks would have already reduced their holdings to some extent, may have been compensated to some extent by Fed continuing to buy under the QE program. But yes, if more and more central banks, start to diversify and ask for payments in their respective currencies, particularly suppose the European countries start to demand euro, or the Chinese exporters start to demand payments in yuan, then obviously the RBI would also diversify the reserves into these currencies. By it's out of necessity they have to diversify. So also it means that they will obviously take into account the stability of the respective national currencies and how they can deploy. For example, if you shift, let's say, about $50 billion into ruble or yuan, you can't just keep it in the in the normal account. You will have to deploy it in some assets in China or Russia. So these countries will have to develop a good bond market or asset markets where the central banks can place their reserves, so that it becomes easier for those diversifications to happen. Right now, only US has an extremely well-developed liquid treasury market. Even Europe is just started to develop that. I think in 2020, post-pandemic, first time ever, they come out with a common European bond, which started to increase the demand for euros. So it is very important that you just cannot convert your dollar into euro or yuan and keep it in a account where there is no yield. You will have to deploy it in some assets in that particular country. So those countries will have to develop those instruments. Till then, this diversification is going to be a very slow process, and it may be on a need-based approach that these central banks will approach.
Okay, that was very insightful. And as JK said, for any kind of diversification by central banks, the underlying bond markets needs to be developed further.
Sorry to interrupt you. This week we have another important event. RBI's monetary policy is going to be announced, RBI MPC is meeting on 6th, 7th, and 8th, if I'm correct. And we'll have to watch what stance RBI takes because of the global inflation. Also, of course, it has been in place for some time, but now it started to impact us also. We had several rounds of domestic fuel price rises, and last 2 months we have had inflation on CPI going above 6%, and this is well above the 4.5% for the full year that RBI has indicated. Let us see, wait and see whether RBI revises their forecast on inflation or growth, and whether they even give any subtle hint of change in their stance. So I think the local market, particularly the domestic equity and bond market, will be very closely watching out for RBI's meeting outcome on Friday.
Right. Adding on to what you just said, we also were seeing talks of Russia offer oil to India at a very discounted, I think $35 a barrel or something,
Yeah.
to the pre-war price.
Yes.
What is your expectation? When is it actually going to take place, and what kind of impact can India see? Because on the retail side, we are seeing fuel price hikes in petrol and diesel prices, right?
So I think Indian government has to treat very cautiously on this. You cannot draw the wrath of these Western nations who are, though officially not putting a sanction on oil imports. If any country is going to increase their oil imports from Russia, indirectly, nullifying the impact of, partially nullifying the impact of any sanctions, there will be some implications. So definitely it is in our favor. We have still not seen a categorical statement from the government whether they are actually going to increase their. Right now, we were importing very less quantity of the overall import of oil from the Russian side, but whether it will go higher is something that we need to see. So not clear. I mean, we have to wait. This is something that is evolving. We'll have to see.
Yes, as JK said, we have to wait and see for how this plays out, as well as we have got the RBI MPC meeting coming in as well. As I was saying, it is a pleasure to have you, JK. Thank you so much for taking up the time to take our viewers through the important developments of the week.
Thank you, Swaraj. Thank you.
Thank you, and
have a nice weekend all.
Yeah. And we will see you all next week. Till then, stay safe and take care. Bye-bye.